this year with interest rate moves and inflation concerns still persisting. So we will actually delve into that in depth with expert speakers from JPMorgan Asset Management. Together with me is also our Director of Investment Research, Min, as well. So thank you for joining us tonight. So we're going to get going here. We have a couple of disclaimer slides that we need to show. And I think we have some people joining us here from Singapore, but this is a Hong Kong webinar. I'm really excited about our continued expansion into the Hong Kong market and partnering with JPMorgan Asset Management. Also, a quick housekeeping on Slido. Please type in Endowus 2023 on your Slido, and you can actually write your questions, but more importantly, you can actually upvote it. At the end of this session, we'll do a Q&A, and the most upvoted questions we'll deal with. Okay. Our guest speakers, Elisa and Jonathan, are very experienced professionals. I do want to, Elisa is going to speak and introduce JPMorgan Asset Management in a short time, but I did want to say that obviously JPMorgan Asset Management, one of, if not the most strongest brand in the fund management business here in Hong Kong, with a long history locally here in the city, and some of the best products out there. So we're really excited about Endowus's partnership with JPMorgan Asset Management here in Hong Kong and across the region. We have a great relationship. Elisa's joining our webinar for the first time. Jonathan, an old friend who has joined our webinars and our conferences before, an excellent speaker that I'm really excited was able to join us today to talk about fixed income. Just a quick few slides on introducing Endowus for those people that are less familiar with the brand. Endowus is really here to empower individuals and families to thrive and achieve their goals in their investing journey through professional institutional advice and access to great products like JPMorgan Asset Management products delivered at a low, fair, and transparent cost. Really so we can all invest better to live better. And we're backed by some of the largest financial institutions, including the biggest private bank, UBS. We actually manage total wealth through Endowus. It really boils down to three of the key tenets of success in investing. One is advice, the second is access, and the third is cost. And really, we are the leader in this conflict-free, independent fee-only business model. And we really are really espousing an endowment style investing for all of us, touching multiple asset classes, including now private markets and alternatives, as well as traditional asset classes like fixed income. Next page. And we're very missional about financial education. This is why we hold these webinars, so that we can empower individuals to be more literate and be educated in their financial investment journey. We have more than 1 million unique views in our insights articles, where we talk about personal finance, retirement, and macro and investment markets. And then we also hold these webinars, and these are always on content that is free to any individual. You can sign up by scanning the QR code on the left to our insights, where you'll be delivered curated content just for you. Next page. And one thing that we really are very focused on is lowering cost at every layer, because cost matters. We know that investments compound over the long term, but also cost compounds. And there's multiple layers of cost that we need to remove in order for us to have a more efficient access to products. So there's multiple transaction-based fees, there's trailer fee commissions or retrocessions. And even if you're doing stock trading, it's not really free because you pay for flow, which is a bad practice. So there's multiple layers of fees that exist when you're investing as an individual retail investor. And Endowus is really about trying to improve transparency, improve alignment, reduce fees, because over time, even a 1% difference in fees over 30 years results in a compounding difference of 250% in returns. So it's something that we can immediately do that will improve our returns with no extra effort or cost. Next page. And one of the examples that we use is, the JPMorgan Income Fund, which is a very popular fund across multiple different distribution platforms. There are a lot of fees embedded into the distribution channel, and Endowus is really trying to provide an independent, fee-only, transparent fee structure so that individuals know exactly what they're paying for, and they pay Endowus the advisory fees or the access fees to us directly instead of through hidden commissions or trailer fees. So that's the effort that Endowus is really about. And we want to focus also on advice as an individual and allowing them to make better choices. With that, I'm going to hand over to Min to introduce our investment office capabilities and how we work with partners like JPMorgan Asset Management.
Thank you, Sam. So just a little bit more on the platform that Sam talked about, how we try to achieve this conflict-free investment model. So we've been fortunate enough to work with the best and largest fund management companies. You can see on this page, JPMorgan Asset Management being one of them. We work with our partners to bring in solutions that were previously available only to institutional investors and make them accessible to everyday investors. So helping our clients to save and grow their retirement money, or for other reasons such as children's education or down payment for a home. So the next question you may ask is, how do you decide which fund should be on the Endowus platform? There are tens of thousands of funds available to investors. What we do is we have a framework. It is called Smart Plus. The S stands for screening, and that is the first step of our process. We have a proprietary quantitative screen that helps us conduct an initial filtering of the fund universe in Hong Kong. M is for measurement, and this really refers to how we measure the risk-return trade-off of each fund, the portfolio characteristics, and these all help to form our performance expectations for the funds. Looking forward, so going forward, how should the fund be performing? After this step, we assess each fund in further detail by having due diligence calls with the managers. So someone from JPMorgan would sit with us and talk to us about, the fixed income strategy. And then we will take it back, do some more research, and come to an assessment of the fund. For those funds that are shortlisted, we will send a very detailed due diligence questionnaire that helps us do deeper dive into the investment merits of each of these funds. From then on, we will then select one or two funds to add to our platform. And last but not least, after we've added these funds onto the platform, we still keep track of them to make sure that they're still meeting our criteria, standards, and performance expectations. This is really a flow chart of that curation process. After the selection of what we deem as a best-in-class fund, what we do is we negotiate and work with someone like JPMorgan to bring you the institutional or clean share classes with no embedded trailer fees where possible. It is not always possible to get access to institutional share classes. So if that's the case, what we do is we ensure that the trailer fees that are embedded in the fees are returned to you as cash. So you're no worse off than had you invested in the institutional share class. So those funds that we talked about, those are the ingredients. And what we now have is a recipe, which is the model portfolio. And the clients are really helping us to eat the dish. So here, the model portfolios are curated using and built using the best-in-class funds that are on FundSmart. We have a series of model portfolios. The first is the core portfolio series, which is globally diversified portfolios that are tailored to meet the risk tolerant level of each client. And all this it could be 100% equity, 100% fixed income, or anything in between. And then we have the income portfolios for clients who prefer to have income. We have thematic portfolios, such as something that's focused more on technology or China equity. And then finally, we have cash management portfolios as well. So these are templates and model portfolios that are available to our clients for them to start on their investment journey. And what we've been doing too to further improve our platform is over the past year, we've been adding funds under the alternatives category. So anything from liquid hedge funds to private markets, private credit, private equity, and private real estate. And last but not least, multi-strategy hedge funds as well, to give you access to alternatives. So really, there's something for everyone on FundSmart. And again, the Slido slide here, in case you didn't catch the password earlier, please type in Endowus 2023 to ask questions on all your burning questions on fixed income. With that, I hand you back over to Sam.
Yeah, no, I'm going to hand over to Lisa, who heads up the Hong Kong business with JPMorgan Asset Management, to give us an introduction to JPMorgan Asset Management. Welcome, Jonathan and Elisa. And Elisa, over to you.
Thank you, Sam. So good evening. Thank you so much for taking time to join the webinar tonight. My name is Elisa Ng, head of JPMorgan Asset Management Hong Kong, and it is my pleasure to speak to you all tonight to introduce JPMorgan Asset Management. I would also like to take this opportunity to thank Endowus, to thank Sam for your invitation, and most important, choosing JPMorgan and as one of your trusted partner. Definitely for JPMorgan, we trusted the partnership, and I'm sure together we can provide more insight to the investor here in Hong Kong. So JPMorgan Asset Management is the asset management arm of JPMorgan Chase. Globally, we manage $2.6 trillion of assets, spanning across different asset classes, including equity, fixed income, multi-asset, liquidity, and alternative investment. One thing I want to highlight, which also differentiates us versus our competitor, is our dedicated commitment and investment in our research team. We have an industry-leading research team which conducts over 2,500 on-site company visits annually to help our investors making sound investment decisions. Here in Hong Kong, JPMorgan Asset Management is also a leader in the fund industry with over 50 years of proven success. As an early entrant in Asia, which established our Asia Pacific regional headquarters here in Hong Kong in 1970s, we, JPMorgan, has remained committed to servicing individual as well as institutional investors in Hong Kong. And actually, we have more than 18 SFC authorized funds touching various asset classes and geographic locations for all the retail investors. Other than products providing timely market insight and thought leadership to facilitate our investor making informed investment decisions is also our priority. So for example, this year, there has been so much attention on fixed income under the current rate hike environment. And with the Fed still have chances to raise interest rate later this year, with fixed income still look favorable. So in today's webinar, we are delighted to have our investment specialist, Jonathan, to share with you his insight on the investment case of fixed income for the rest of this year. I hope you'll find the sharing useful. So I guess without further ado, maybe I'll pass over the time to Jonathan and Mint.
Thank you, Lisa. I will defer to Min with any questions that we want to address first.
Yeah, thank you, Jonathan. Actually, we have a number of questions on Slido already. A number of our audience would like to know whether fixed income is the way to go for the second half of 2023, or if they should be going into equities or mixture of two. And if it is a mixture of two, what could be the optimal asset allocation? Maybe can we address that, or go into that?
Sure. So I represent the fixed income side of our investment platform at JPMorgan. So maybe I take my asset allocation advice with a grain of salt, but even our market insights team currently is recommending an overweight to fixed income this year. And the reason for that is a couple. One of the things is that yields have repriced much higher than where we were at the start of 2022. And in addition, we have reason to believe that we may be closer to the end of the current rate hike cycle in the United States. And if we look at history, every time the Fed ends its rate hike cycle, and by the way, I'm not even talking about rate cuts, I'm talking just ending, no more rate hikes. After that, the returns in fixed income has historically been double digits. And so right now, we have a preference for high quality duration within fixed income, but we also recognize that currently with the yield curve deeply inverted in the United States, that we also need to put some curve trades on as well to try to capture the normalization of that yield curve inversion going forward. So definitely 2023 likely going to be, in the second half at least, going to be a year for fixed income, we think, very well positioned, because the markets are forward looking. So even though we think that there may be one more rate hike in July and then potentially one more in September, that one is probably going to be the last. Because the markets are forward looking, you don't want to wait until September to invest, because by then the market would have already moved. So we think right now is a pretty interesting time to be involved in fixed income.
Okay, great. Thank you. And I know you can talk about what happened in the first half of this year with regards to fixed income. So I'll let you go into it.
Okay. So what we have here on this chart is the year-to-date performance of different fixed income sectors. And generally speaking, you can see that on the left-hand side, so the leaders on the left-hand side and then going to the right are the relative, still outperforming, but still positive performance, but maybe less positive. So the leader this year has been local currency emerging market debt. And it's a combination of capital appreciation as well as income, as well as FX. And we think that makes sense because emerging market debt countries have really led the Fed in terms of their monetary policy hiking cycle, to the point where some of the highest real yields today are to be realized in EM local currency debt. And as the market is pricing in that the Fed may be done soon, and that emerging market countries have room to cut rates, that EM debt, local currency debt this year has done very well. But one of the surprising things is also U.S. high yield, which is number 2 here on the left-hand side of the chart. And it's surprising because we believe that with the Fed hiking so aggressively, that the economy in the US will likely slow down this year and may even enter a recession towards the fourth quarter of this year. And in that environment, high yield is not supposed to do well. Yet, as you can see from this chart, it is done fairly well. And so our high yield allocation within our income strategy has been helpful. However, we are starting to be a bit more cautious, and spreads are quite tight in high yield right now. And so we're using that opportunity, because when spreads are tight, the cost to hedge your high yield exposure is cheaper. And so we're using the good days in the high yield market to increasingly hedge our high yield beta, if you will, within our strategy. And so valuations, we think, have room to cheapen in the second half of this year, particularly the stock market doesn't do well. So we want to take advantage of the cheap spread in high yield at the moment to hedge some of our exposure. And then the rest of the fixed income markets have generally been positive. Recently, there's been some volatility given the market has repriced 2 more rate hikes in the US, and that has caused some volatility in the bond markets this year. Yield curve further inversion has also caused some volatility, but that only means that yield to maturities are higher, and so future return potential is also higher.
Okay, great. Thank you. Maybe, you mentioned recession possibly later this year in Q4, and we have a couple of questions on recession, actually. The first is that, will a recession cause a spike in credit spreads, offsetting the effects of potential rate cuts? So that's the first question. And the second question is, let me see. Okay, there was one here, but let's just address that one first, if okay.
Yeah, sure. We can address that one first. We actually have a chart on that on page 8 at the end of this presentation. Sorry to jump around. Um, okay, so that's one. Sorry, the next one.
Oh, okay. This one?
No, the last page. Yes, this one. Yes. Okay, so actually high yield corporate fundamentals right now is actually not too bad. Default rates right now is still running at only 1.6%, which historically is quite low, as you can see from the yellow line on the right-hand chart. The issue, though, is the blue line. The blue line is high yield spreads. And when you look at that line, you can see that yield spreads are definitely not pricing in a recession. Typically, when we enter some kind of crisis or a recession, you can see that blue line will spike up to about 800 basis points. And right now we are in the mid 400s basis points. So high yield market definitely not pricing in a recession. Now, having said that, we are also not expecting a very severe recession. And so we think the default rate on the left-hand side, the green line, they tend to track credit conditions, which is the purple bars. The purple bars there is the US Senior Loan Officers Survey. And it basically tracks banks' willingness to lend to individuals, to corporations, businesses, etc. And when that purple line is upward, positive, that means banks are tightening their lending standards. And when they do that, high yield default rates tend to trend upwards as well. But because this recession is so well expected or anticipated by everybody, CFOs in the US have generally run conservative financial policy on corporate balance sheets. So leverage ratios in high yield in the US is actually pretty benign. And so even if we get a recession, we think the default rate will only spike up to maybe 3-4%, which on the right-hand chart, you can see is actually lower than, say, previous crises like the global financial crisis, like the dot-com bust from 2000, like the COVID pandemic, where it spiked up to about 7%. So we think this cycle, yes, default rates have room to rise, but not likely going to be to astronomical levels. And because of that, spreads maybe don't have to widen to 800, and we see value starting to emerge around 600 basis points, we think, in US high yield. Anything above that, we think that's a pretty compelling valuation. But before we get there, to my earlier comments, we probably want to hedge some of our high yield exposure in anticipation of a potential spread widening of that blue line on the right-hand chart.
Okay, great. Thank you. And maybe just going back to what you said previously about how JP Morgan is actually very bullish on fixed income versus equity. There's a question that somebody's asking where the interest rate path is uncertain. Inflation looks like it's coming down in the US. There is still, a couple of hikes that people are thinking would happen. So is, fixed income and strong conviction in fixed income still valid?
Yeah, so for that, maybe apologies for skipping around a bit. We go back to the beginning on page 3, where we can take a quick look at recent market expectation movements. Yeah, this chart. Yeah. So what we're looking at here is the futures market in terms of policy rates in the UK, Europe, and the US. And for the purposes or for the relevance of Hong Kong investors, I think we should probably focus on the US expectations, and that's the blue line. And that's basically the OIS market's pricing of what they expect the Fed to do. And the dotted line is what they were expecting at the end of the first quarter. And the solid blue line is what they're expecting on June 30th, more recently. And so you can see the futures market has basically priced in that they think they were a little complacent earlier, and we were concerned about that earlier, that they were expecting rate cuts, as soon as actually July, and we felt that, well, okay, that might be jumping the gun a little bit. But now that dotted line has moved to the solid line level, they're expecting no rate cuts in the next few meetings, although they are expecting a rate cut towards the end of this year. Again, we think it's gotten a bit more reasonable given the upward movement in expectations. So that does give us, and the US Treasury curve has also repriced upwards. So that has given us a bit more conviction that the worst may be over. And we actually do think that the 10-year Treasury at anywhere upwards of 3.9 starts to generate quite a bit of buyers in the market. And so from a market technical perspective, we think at current levels, there's quite a bit of demand for US Treasuries. So we think that because the markets are forward looking, the moment the Fed pauses and indicates that they might be done, which we think could happen as soon as September, that the markets will move. And so that is behind our conviction on fixed income this year. So historically, whenever the Fed pauses in the next 12 months, fixed income historically has delivered anywhere from 11% to upwards to 30% in the past. So now I'm not making any predictions regarding this cycle, but certainly we think fixed income is well positioned to outperform money market funds, fixed deposit rates, given the capital appreciation potential that can be realized when the market starts to price in future Fed cuts.
Okay, I'm convinced. So there's another question really related to what you just mentioned. It's now a good time to lock in the rates by buying 10-year US dollar bonds. And another question is it time to also maybe start taking on additional duration?
Yeah, that is not a simple, there's not a simple answer to that particular question. The reason I say that is because right now the US U curve is inverted. So 10-year Treasury yields are yielding 3.9%. 2-year Treasury yields are yielding 4.8%, 4.9%. And so the U curve has rarely been this inverted. So if you just extend duration simply, you're locking in lower yields at the long end of the U curve. So we think right now what the market is pricing in is that with very restrictive monetary policy, the bond markets are basically saying that going forward, there's going to be a significant economic slowdown in inflation, and the Fed will likely have to cut rates. That's what the market is pricing in. Now, but the moment when the Fed pauses and then starts to look ahead at when do they need to cut rates, the U curve will then uninvert, we think, because short-end yields will then start to price in that 2-year part of the curve, for example, will then start to price in, okay, what's policy rate going to look like in 2 years' time? And we think that's going to be lower than 4.9. So we think beyond having duration, and we would favor the belly of the curve right now, the intermediate part, called 5 to 7 year part of the curve. But at the same time, we would also put on a curve, technically is a curve steepener, but for folks that sounds kind of complicated, is basically putting on a trade that is positioned for U curve to uninvert. And so right now we would be potentially maybe short the 10 to 30 year part of the curve, but then be long the 2 to 5 year part of the curve.
Okay, that's great from a fund manager perspective, but for retail investor, what would you suggest? And also, there's a question on whether it's a good time to lock in the rates, because if we think that rates are not going to go up that much, then should an investor just buy the 10-year bond and just kind of get that coupon and lock it in?
Well, you lock in 3.9% 10-year, that's okay. But right now, for example, our income strategy, the yield is about 7.5%, almost 8%. I think you can lock in that yield right now. And the other thing is for retail investors, given what I just said, curve steepeners, CDX hedge over high yield, and then also one of the other our favorite sectors is actually agency MBS. These are not like securities that you can just go to your broker and buy. Typically, if you're a retail investor, so the best advice would be to invest in a very strong, unconstrained, nimble fixed income strategy, and that's what the JPMorgan income strategy is all about. We currently do have high yield exposure, which has helped year-to-date performance, but because we're worried about economic slowdown and recession, we're gradually building up a CDX overlay to manage potential spread widening in high yield. We have the curve steepener on. That unfortunately has been a detractor to returns year-to-date, but we would argue that we are early on a curve steepener trade, but eventually the yield curve cannot stay inverted like this forever. And eventually when it normalizes, that curve steepener is going to help our performance. And finally, we have a pretty healthy allocation to agency MBS right now. Spreads are at levels that we last saw during the global financial crisis, but these bonds are fully backed by the U.S. housing agencies, Fannie Mae, Freddie Mac, AAA rated, U.S. government backed. So you're basically taking on AAA credit risk, but you're getting a yield spread of about 140 basis points over treasuries, which is better than treasuries. So all in, when you combine all these ideas that I just talked about, you can lock in, something in the high sevens right now with our income strategy, and I think that is better than the 10-year treasury.
Yeah, that's really a popular strategy. I know. So another question I have is, what about emerging markets? So fixed income emerging markets, is that something that JPMorgan is kind of bullish on? And also the Eurozone, the UK, do we expect those yield curves to, they're not as inverted as the US yield curve, but do we expect them, that the central banks, to kind of follow what the Fed is doing right now?
So I'll answer the emerging market question first. So emerging market debt, in our opinion, the opportunity right now is probably in the local currency space, where yields are still quite very high in certain countries like Brazil, South Africa, Mexico, etc. And importantly, the yields are much higher than their own local inflation levels. So that means their real yields are very high. And because emerging market countries have been more aggressive than the Fed in their rate hike cycles, they can probably start cutting rates earlier than the Fed. And so we think that's where the opportunity may be. The currency part is a question, because the Fed's not quite done yet. Dollar strength may yet persist for just a little while longer. So we want to be a bit careful about, because when you buy low currency EM debt on an unhedged basis, you're also taking on the FX risk. And the FX risk can very easily overwhelm the fixed income beta of your bond return. So we want to be a bit more careful about that. So in terms of sizing allocation to EMFX, we would be prudent about that. But we do recognize that there is an opportunity there. Hard currency is a bit more fairly valued because, basically, if you want really high yield, you're going to have to buy the sort of basket cases that are in IMF programs and still, going through restructuring. Meanwhile, the stronger sovereigns, they're not trading particularly cheap. So the opportunity within EM is probably on the local rate side at the moment. Now, turning to Europe and UK, we think that they are a little bit more behind the curve versus the Fed. And the Fed probably ends their rate hike cycle earlier than Bank of England or ECB. And so we think the opportunity right now, and given one can argue that UK gilts are quite attractively priced, but the thing is, inflation is a bit more of a problem in the UK, and the Bank of England probably has a bit more work to do than the Fed. So we think if we compare US to Europe to UK, we think the US probably ends their rate hike cycle first.
Great, thank you. That's very insightful. And maybe now moving to a market that's a little bit closer to home, Japan. What do you think about Japan and where it stands and what it will look like going forward in terms of, rate cuts, hikes, and the yield curve?
So right now, the central issue in Japan is, when does the Bank of Japan give up yield curve control? So right now, for investors' education, right now the Bank of Japan is basically buying Japanese government bonds, we call JGBs, in an effort to hold yields at a particular level, very low level. But inflation is starting to become elevated in Japan for the first time in many decades. For folks in Hong Kong, who many of which like to travel to Japan, you may have noticed that many items have repriced higher in Japan. And so at some point, yield curve control probably becomes inappropriate for Japanese monetary policy. And when they give up yield curve control from yield levels that is very, very low, artificially low, there's room for yields to spike up quite a bit in Japan. So we would definitely not recommend buying Japanese government bonds. However, when they do give up yield curve control, that we do think that there is room for the yen to appreciate from where we are today. But if the Bank of Japan persists in holding on to yield curve control while the Fed hikes 2 more times between now and September, then the potential for the yen to appreciate in the very near term might be limited by that. But at some point, we do think that the yen becomes an opportunity, and we should probably be very careful about avoiding Japanese government bonds or Japanese interest rates.
It's probably still a good time to visit Japan, since the yen is still,
Yes,
a little bit lower than it used to be.
Yeah, the only issue is Cathay Pacific airfares. That's but yes, I mean, certain items in Japan have repriced higher, but some have not. I remember a recent visit to Japan and going to the supermarket and finding some pretty attractively priced items, but some higher end restaurants, their menu prices have become very attractive. Hotel prices have also gone up quite a bit in Japan as well.
Great, thank you. So I'm still seeing a lot of questions and upvoting of on recession related questions, actually. So maybe do you want to just discuss recession a little bit? What JP Morgan is thinking in terms of how severe it would be and how likely it would be?
So we think that there's better than even odds that we will see a recession towards the end of this year, 2023, in the US. And the driver of that recession, we think is going to be a tightening of credit conditions. And if we go back to that high yield slide back in page 8 at the end of the presentation, so I mentioned that I think the recession we brought about by a tightening in credit conditions, you can already see that happening on the left-hand chart. That's the purple bars. That's a senior loan officer survey. So many of you may have read that a couple of banks went under in the US this year. And so, and there is for certain, particularly US regional banks, there is a sort of asset liability mismatch where they fail to hedge their sort of interest rate risk between their deposit rates and the securities that they have on their balance sheets. And this issue is more acute in the regional banks. The reason for that is because in the US, there is a very curious arrangement where only the systematically important banks like JP Morgan get subject to annual stress tests by the Fed. Meanwhile, the ones that are deemed to be less of the larger banks, less systemically important banks, they're not subject to the same stress test. That's why this issue with the asset liability mismatch between in the regional banks was sort of went unnoticed by the regulators. And which then when interest rates moved up and then money market fund yields moved up, bank deposit yields didn't move up as fast. People started pulling money out of banks and put it into money market funds. That's when the banks had to realize some losses on their securities portfolio, and then that caused some of the bank problems. That problem hasn't quite gone away yet. It may have become less acute, but there could still be some hidden losses that have not been realized yet, and that is causing a lot of hesitancy by banks to lend to businesses, to individuals. And when lending or credit dries up in the economy, things slow down or enter a downturn. Default rates go up. So that's what's going to drive the recession, we think. The pullback in lending is also going to affect capital spending, capital expenditure in the United States. And when you look at historical recessions, they're not usually driven by consumer downturns. It's usually driven by a pullback in investment and capital spending. And that we think is going to become more apparent towards the end of this year.
Okay, great. So, I mean, the likelihood of being a recession is quite high, especially because of the tightening that has occurred in the past year or so. And so this is not just unique to the US, but you would say it's more on a global scale.
Yes and no, because that unique situation I talked about where the big banks get stress tested and then the regional banks don't, that issue is not the same in Europe. In Europe, every single bank gets stress tested by regulators. So they have less of that asset liability mismatch issue. And in addition, given after the European sovereign debt crisis, the European banks really, bucked up and fixed their balance sheet to the point where the capital ratios today is much higher than where they were in say 2011, 2012. And so they're in much better shape than say U.S. regional banks. So maybe that tightening credit condition is less obvious in Europe. So we think, especially if the Fed would have hiked 2 more times between now and September, then I think the recession risk in the U.S. is actually more elevated than in Europe. In the UK is a different situation. UK is the economy is a bit more vulnerable, but this tightening of credit conditions is a bit more apparent in the US than the other major developed market regions.
Okay, I'll come back to that, but there is a comment from one of our audience, is that so we mentioned, I think you mentioned JP Morgan income is at about 7%, and I think he or she is wondering, how do I lock in 7% yield for the next 10 years? So maybe can you just very briefly describe what a flexible income strategy does in order to get as much yield as possible? So I mean, yeah, just a maybe a brief overview of what flexible income strategies do.
So I'll say what our flexible income strategy does. I don't know how other people do it, but our income strategy basically takes an unconstrained approach to the global fixed income markets, and we look at it from both a top-down as well as bottom-up view. And that top-down, we want to have a view of, okay, how much risk do we want in the portfolio right now? What kind of risk do we want in the portfolio? What are the risks that we want to avoid from a macro perspective? And then, so then that sort of decides our risk budget, and in a completely benchmark unaware manner. Bottom up is our over 200 strong sector specialists in our fixed income platform that helps us pick the individual bonds. And we end up with a portfolio that has about almost 2,000 securities that collectively give you about 7.5% yield. And right now, duration is running just over 3 years. And so now it may be hard for us to lock in 7% for 10 years, but if our yield were to drop in response to a broad-based drop in yields in the fixed income markets, you will see that reflected in capital appreciation and our NAV. So the returns historically during these inflection points when the monetary policy cycle turns, again, is sort of in the low teens, right? So while now 10-year Treasury 3.9%, if you get double-digit type return, you're basically bringing forward that return by 3 years. So that's what our income strategy does, and the important thing is that you don't want to hug a benchmark right now, because maybe in the short term it makes sense to have intermediate duration, high quality, but fixed income indices are different than stock indices in that, stock market, if you're a successful company and you grow, your market cap gets bigger, you become a bigger part of the index. So that makes sense to invest in an index for equities. But in fixed income, the more debt you issue, the more indebted you are, the bigger you are in the index. So for example, Japan is the second largest country in the global ag index. Do you really want to invest in a country that has over 200% debt to GDP ratio, giving you 0.1% yield? So that's why we think right now, particularly during these inflection points when you have to move, when the Fed sort of reaches that end point in the rate hike cycle, you want to be in the unconstrained benchmark unaware strategy right now. That is very dynamic.
Thank you. So I'm just going to try to summarize and what you've just said, which is that in order to, when you're investing in a fixed income fund, an investor should really be thinking about two components. One is the yield, and the other one is capital appreciation. So even though, as interest rates go down, your yields may drop, but the value, the price of the bonds are going to increase. So therefore, there's the potential for higher capital appreciation. So to answer some of the questions from the audience, I think it's we really have to think about more of a total return kind of mindset, which is yield plus capital appreciation.
Yes.
So anything you would like to add, Jonathan, to that?
Yeah, I think right now, generally speaking, in our income strategy, we are trading right now at our second highest level in terms of our yield. And starting yield to maturity is a pretty strong predictor of your future returns, right? You want to predict, say, stock market returns, you've got to consider a couple of things. Earnings growth, what's that going to look like? What do PE ratios look like? Does it expand? Does the ratio contract? There's many different moving parts. In fixed income, yield to maturity is pretty, I mean, it basically is just showing you that number basically captures the bond going from whatever price it is to par, and then you collecting coupons along the way. And so yield to maturity and your historical total return has a pretty tight relationship. And so right now, we think the income strategy is very well positioned to deliver very compelling returns in the next 12 to 18 months.
Okay, great. Thank you. So just maybe another question on China. Somebody is asking that China's economy appears to be faltering a little bit, the recovery. So how do you think that's going to impact the global economy? And how does that in turn affect JP Morgan or a fund manager's views on fixed income?
Well, first of all, we have zero exposure in China in the income strategy. And the reason is I mean, I don't want to say we saw this coming, but we didn't have a particularly positive view on the economic outlook for China. Once upon a time, we did like the government bonds in onshore China because when the economy slows, yields drop. And once upon a time, Chinese government bond yields were higher than US Treasury yields, but now that has flipped. So we no longer have a bullish view on China rates. And we have always had a pretty cautious view on China credit. So that's sort of our summary view of China at the moment in terms of fixed income. As it relates to the spillover effect to the rest of the world, China slowing down is not necessarily such a bad thing at this part of the economic cycle. The reason I say that is because you want things to slow down to control inflation, which is the number one problem facing fixed income investors today. And so China not sort of growing at 8% on the margin helps with global inflation. I mean, take oil demand, for example. With China slowing down, oil demand going down, oil prices have less room to rise. That benefits the inflation outlook in the US. So we think China slowing down is not necessarily a bad thing. Now, China entering a crisis, that's a different thing. That is not something we're predicting. The Chinese government is, I think, rightly recognizes that the economy is faltering. So every other week, there's some announcement of some new supportive policy for the Chinese economy. So we think that the China economy will probably muddle through the next few quarters. But that is not necessarily a bad thing given the inflation issues around the world.
Okay, that's very helpful. Thank you. I mean, there's some questions too on what kind of fund we're discussing. So somebody from Endowus will reach out to you to answer that question. But to get back to what we were saying, maybe since we have about a few minutes to go, Jonathan, do you want to just kind of wrap up on your outlook and also just a framework on how to think about, the recession that's coming and how you should position your portfolio, your fixed income portfolio?
So I think in summary, we think the US economy is poised to slow down or enter a mild recession towards the end of this year. Therefore, we believe the Fed may be close to the end of its rate hike cycle, potentially as soon as July, but we have high conviction that September will be the last one. And if that is the case, historically, whenever the Fed ends its rate hike cycle, the subsequent 12 months is very good for fixed income, particularly high quality fixed income. So right now, we would say move higher up in credit quality, have a bit of duration, and take an unconstrained active approach. And right now we've got a couple of trades on an income fund that is quite interesting. Euchre steepeners, agency MBS, but in short, 7.5% is a pretty good starting. 7.5% yield to maturity is a pretty good starting point for compelling future returns, especially when the Fed is about to be done with interest rate hikes. That would be a key takeaway today.
Great, thank you. So just to kind of reiterate what you're saying, what JP Morgan is seeing and thinking is that higher quality, in the case of maybe a recession in the future, or when the Fed starts to pause and maybe even cut rates likely in the future, taking on some duration. So would you say, Jonathan, higher duration relative to the benchmark, or just, like maybe more than 3 years?
Again, it's not just outright just long duration, given the yield curve inversion, right? So you need to also position yourself for normalization of that inverted yield curve in the US. But having intermediate duration, and I would define that as between a 3 to 5 year part of the curve, probably is the sweet spot. And that is where we kind of are at in the income strategy at the moment.
Yeah, okay, thank you. So an unconstrained, flexible fixed income strategy would probably be allow the fund manager to navigate those uncertain fixed income markets and kind of get the best returns possible.
Yes.
Okay, great. I think we're at the hour now. So I like to thank Jonathan, you for taking the time to talk to us about fixed income. I personally found it very insightful and very helpful, and look forward to having you again on our webinars. I think Elisa and Sam had to drop off, but also thank you to them, and please give my regards to Elisa as well.
Thank you. Thank you for having us. Enjoyed today's session very much. And if there's any follow-up questions, please reach out to us and we will answer them for you.
Thank you. Thanks, everyone, and have a great night.
Thank you, everybody.